A lot to unpack on this week's episode. This week, I want to chat a little bit more about those CPI headline inflation numbers that came in lower than expected. What is it telling us? What does it mean? What we should be looking for? As well as what does that data mean when we look at the US and what's happening just south of us and how that could influence the Bank of Canada ahead of its March 6th policy rate decision. And we'll share some of our insights and thoughts on what to expect or what we should be looking at from the Bank of Canada as we move forward into 2024. So we welcome you back to the channel. If you haven't subscribed to the channel, we invite you to do so. Hit that notification bell. Don't forget to leave your comments and questions in the comment section below. Like and share the video so we get this content out to as many Canadians as possible. So this week, obviously we saw the Stats Canada numbers, those CPI inflation numbers coming in at 2.9%, much lower than what many economists had predicted. That was supposed to be around 3.3, 3.4%, depending on what news outlets you were following. Now, this is obviously good news nonetheless. I mean, inflation coming down within that bandwidth of 1 to 3% is a positive sign. But 1 month's data isn't a trend. And we did see inflation prints lower than this back in June of 2023. And following that newsprint where many people in power, many politicians, including Chrystia Freeland, were touting how they got this inflation number back down, that was very short-lived, and then we saw inflation tick back up. So it continuously supports the case for the Bank of Canada, saying that inflation is very sticky. It's going to be volatile. And there are so many different components that pushed that 2.9% CPI headline inflation number. Now, it's important to point out that the headline, the news headline, is as important to many Canadians and obviously what we see. But to the Bank of Canada, the major numbers that they pay close attention to are what we call core numbers, the medium and trim. These particular numbers are still elevated, hovering around 3.3 and 3.4%. They have come down from their highs in December, but ultimately those are the numbers that strip out volatile things like food and energy. And if we look at that 2.9% CPI headline inflation print, well, what did we see happening just in the month of January? We saw that fuel prices were definitely lower. That's helping to push that inflation number down, as well as we saw some food prices being pushed down as well. But that's because a lot of grocery stores had a freeze on particular items, and that expired in February. So I think the 1st of February is when it actually expired. So we'll see what happens now once we get into March and we look back into the February numbers. Are we going to see this continuity in these inflation numbers? Will that number still stay below 3%? Will core, medium, and trim numbers still stay below 3.5 and continue to digress further towards that 1 to 3% target range? Remember, they want to see it at around 2%. That's sort of the target goal. Now, obviously, there is some leniency in that, but ultimately, I believe that number, it's great. It's showing that we are on the right trajectory. Things are starting to shape up, but it's not going to be an easy road ahead, especially if we take an opportunity and look at what's happening in the US. So let's take a look at the inflation numbers in the US that came out, I think, just about 2 weeks ago now, where inflation print came in higher than expected, right? So we have Canada coming in lower, very good, US coming in higher. Ultimately, we know that if inflation in Canada came in a lot higher or matched what we saw in the month of December, well, we definitely would have been having a different conversation right now, one that would probably be along the lines of Bank of Canada probably hiking rates. And that's exactly what is happening right now in the US. They are contemplating the conversation. Now, we're not saying that it's going to happen, but some economists are saying that, look, there's a possibility that the US Fed can hike rates right now. So not only because there's higher inflation numbers, these PPI numbers, the producers index, right? These things are very, very important, as well as we're seeing consumer spending in the US. So it's showing the exceptionalism in the US, the resiliency of the US consumer, as opposed to the Canadian consumer. Now, why is there this divergence between the two economies? Well, obviously there's a few things that we need to consider. In simplest terms, when it comes to mortgages, debt, and spending disposable income, well, we have to look at the Canadian versus US mortgage market. We've talked about this in the past. And just as a quick refresher, in the US, the terms or mortgage is usually around 30 years, 30-year mortgage. So think about taking out a mortgage, low rate, 30 years, many Americans locked in at the ultra lows that we saw just a few short years ago, as opposed to Canadians that take on usually a 1 to 5 year product. And over the course of the last little while, it's been very popular, it's been a 3 years. So we can see how quickly these Canadian mortgages are going to be renewing, which exposes Canadians to higher interest rates, more actual cost per month. We saw that in the mortgage interest cost component of the CPI, which is still a big part of why inflation is still elevated. And obviously that is a conversation for another episode. But looking at those numbers, we have to understand that as these Canadians renew their mortgages, 60%, according to many statistics, have not yet renewed their mortgage. That means they haven't felt the pressures of these higher interest rates just yet. And we've seen what's happened with the other 40% that already have renewed. They're going to be pulling back on spending, less disposable income. On the US front, obviously, Americans are not in that same boat. They're 30-year exposure versus a 5-year exposure when it comes to these interest rates. It's telling the US Federal Reserve they can sustain higher rates for longer to get that inflation down, as opposed to what's happening in Canada. I don't think here in Canada we can support these higher rates for much longer without having some major impacts, not only in housing, not only in rents, but in the everyday Canadian, their spending, their earning power, their debt loads. It is a big problem. So we have these two divergent economies coming in front of us right now ahead of March 6th. And if we dissect those two economies, I believe that with the inflation print coming in now at 2.9% lower, it does lead the Bank of Canada to potentially have the conversation about cutting rates. But I don't think that's going to be the case ahead of March 6th or on March 6th. When the Bank of Canada meets with the Governing Council, the deliberations are going to be closer to the holding pattern. This 2.9 does basically solidify that the Bank of Canada does not need to hike rates just yet, but they will be able to hold that pause button maybe a little bit longer. The question for many Canadians is who's going to break first? Is the US going to cut rates, or is Canada going to cut rates first? I mean, that's the million-dollar question. And to be honest, I don't see Canada leading the front on this path because there's a lot of conflicts. I mean, look, ultimately, at the end of the day, it's a forecast, and I believe the thesis that I would support is that the Canadian economy, the Bank of Canada, is obviously not performing on all cylinders, not firing on all cylinders. Therefore, I think they're going to lean on the bank, the US Federal Reserve, to make the first move, or at least watch what they're doing. They're not going to cut rates ahead of the US because they are worried about, obviously, the gap, the disparity between their policy rates. If that gap widens too far, well, that could mean that our US dollar, the US dollar to the Canadian dollar changes, right? The Canadian dollar can gain some momentum. That means, we could be importing inflation. We could not be importing inflation depending on what direction the US takes. So ultimately, these are data points that should change our mindset as we move forward. So that is very important. I think the Bank of Canada is going to come out on March 6th talking about the job not being done just yet. I think they're getting closer to that conversation, especially here in Canada. I think if it was up to the Bank of Canada, I firmly believe that the Bank of Canada would be cutting rates. I think they could be cutting rates, but they're not going to do that for several reasons. One of those reasons is because they do not want a relapse of what happened in the late 70s and early 80s. The Bank of Canada wants to ensure that inflation is absolutely dead. These numbers, these inflation numbers, not only headline, but also core, medium, and trim, these numbers that the Bank of Canada looks at very closely need to be below 3%. And if we don't get those numbers below and they stay there, then the Bank of Canada will not be there to cut rates anytime soon, at least in my perspective. And the other thing we have to look at too is the fact that if we still have a real estate market that is bumping back up, prices are starting to surge upwards slightly, not too crazy, but just up enough that it signals to the Bank of Canada that potentially there's still a little bit of exuberance. There's still some money in the system that people are spending. So that could also lead the Bank of Canada to hold in that line a little bit longer and make sure that Canadians feel these financial pressures We're going to be monitoring those job reports, those GDP, the growth here in Canada, and looking at immigration, how many jobs are being created as opposed to how many people are arriving and need those jobs. So this is obviously a very interesting conversation, not just around the inflation front. I think these numbers are very good. I think these numbers are pointing in the right direction. Trust me, it's better than having higher inflation numbers that could have led the Bank of Canada to hike. But I think now the conversation is more along the lines of how long this pause will be before the Bank of Canada is prepared to cut rates. But then the question is when that cut comes. Remember, Bank of Canada meets 8 times a year. We've already had our first announcement. Now we're into our second on March. That leaves us with another 6 announcements. And based on the conversation, based on the analysis, on the economists, they're projecting a cut to happen most likely mid-year, so June. Then the Bank of Canada takes a break. We might see rate cuts in September. That's probably where I would put them at. I would say that's going to happen closer to September, maybe closer to the fall. I don't think we're going to see any rate cuts happening at the current moment. And ultimately the question is depending on the type of product, if you're looking at fixed, you're looking at variable, well, how many cuts are we going to see? How big are those cuts going to be? And are they going to be able to move the needle for Canadians? I think ultimately that's the important question, especially if you're going out there and you're thinking about your mortgage renewal that's coming up in the next little while, or going out in the market to buy and trying to time it. Well, you need to be conscientious about what happens next, right? And we look at the data points, we look at those particular segments, and we've always said, look, most Canadians don't live in a spreadsheet. They have a budget, but they're looking at their financial situation at that current moment, their needs, what they need to do for their family, as opposed to, speculating, I should get into the market, versus someone who's like, I need to buy a bigger home, I need to move, I need to do these things. These are the conversations that we're having. And ultimately, how is the Bank of Canada's decision going to make that difference in your personal decision about when you're selecting whether or not to purchase, and maybe ahead of your mortgage renewal? Obviously, if you have a mortgage renewal coming up, that's another question. Obviously, looking at that timeline, our advice is with what's happening in the bond market right now. Ultimately, as we talked about the U.S., whatever happens in the U.S. signals a reaction here in Canada, and we've seen that happen in the bond market. The 5-year Bank of Canada bond has been very volatile. We saw how at the beginning of the year those bond yields had dropped significantly, causing fixed rate mortgages to come off their highs. But ultimately, with the U.S. inflation numbers, the bond yields have picked back up. And now with the Canadian inflation number coming in lower, those numbers have sort of receded back a little bit because the market is pricing in that cut, right? They are pricing in that the Bank of Canada will be cutting at some point, but ultimately that can shift with month-to-month data. If next month inflation comes in higher than 2.9, well, what do you think is going to happen to the bond market? So if you have a mortgage renewal or a pre-approval that you're looking to secure, it's always best to get it done within the time frame ahead of time so that you can hedge your bet on the fact that if interest rates do go up, at least you're holding on to a better rate. Ultimately, if rates do come down, you're holding on to that pre-approval or that mortgage renewal approval. That rate, the new lower rate, should be given to you by your broker. So I was working with someone that has your best interest in mind, can help keep thousands of dollars in your pocket. But we'll leave the video here wondering what our viewers think about the March 6th announcement. Obviously, will the Bank of Canada hold? Will they hike? Will they cut? And if they cut, or when the first cut happens, what do you think that cut's going to look like? Is it going to be 1/4, 0.5%, 75? I firmly believe that the Bank of Canada, even if they do cut, it's probably going to be very small incremental cuts because they do want to monitor the situation from month to month, announcement to announcement. So we'll leave the video here. Let us know your thoughts in the comments section below. Don't forget to subscribe to the channel, and we'll be following up with another episode next week, talking more about the Bank of Canada, talking about the real estate and mortgage marketplace as things continue to change. So make sure you're subscribed, and we'll leave the video here wishing everyone a wonderful Friday and an even better weekend ahead. We'll see you next week. Thanks for watching.